In this video, I'm going to share why Dan Ives and Wall Street are bandwagon jumpers, and they just follow the stock price of anything they're talking about, and why they're preying on the emotions of the public. Let me first share my disclaimer, and then we'll get into it. So there's that. Okay. So there's always an excuse to make an emotional money decision. Dan Ives just came out today and lowered his price target on Tesla to $250 and took it off his best ideas list. And Dan didn't want to look bad, and he's just going with the emotion of the crowd. He's not standing up for anyone. Wall Street and most brokers are not fiduciaries. They don't put their clients first. Maybe Dan is a fiduciary, but most brokers are not. They just have to meet the hurdle rate of their clients' best interests. They tell people what they want to hear. So if a client calls them up and says, "I'm scared, get me out of the market," what a broker is liable to do is just sell everything for their client. They don't stand up for what's best for the client. And these Wall Street types will say anything, which is why CNBC keeps bringing them on. Yeah, Adam Jonas in 2009, he had his, at the time, as a $10 price target on Tesla. So now that price target would be under $1. So earlier today, Tesla is at $185. So, that was Adam Jonas's bear price target. And he had this big call where people got on and got all scared about Tesla. And this day or the next day was the lowest that Tesla hit in a long time. There's always an excuse. Dan Ives didn't warn the public about Elon Musk and Twitter in April when the announcement was made, or March, or whenever that was. He didn't warn about it when it went to court. He didn't warn about it a month ago, but now that the stock price is down and at the lowest price it's been since November of 2020, Dan Ives comes out and lowers the share price and takes it off best ideas list. Dan Ives doesn't want to look bad. He doesn't care what the right thing is. This is my opinion. This is the opinion of Halter Ferguson Financial. So, this reminds me of 2008 when commodity prices were shooting up. This is the summer of 2008, and oil went to $115 a barrel. Goldman Sachs famously came out with a price target of $147 a barrel. Is a huge upgrade from where they were. And the only reason they did was because they were following the price. That day was the highest price that oil hit in a very long time. So these Wall Street people will do anything. They'll say anything. There's always an excuse, and the excuse is always plausible. They're feeding into fears. I remember after the financial crisis, Nouriel Roubini was very popular on TV, and they were talking about double dip recession, W or a U recession, where it's just going to take forever to come out of it. And he was just preying on people's fears to get publicity. Certainly a smarter man than me. I don't know about wise, but certainly smart. And he sounded brilliant at the time, and he's what Bill Smead would call the brilliant pessimist. And the pessimists sound brilliant. Investing is very emotional. It's tied to money. Money is a taboo, emotional subject. And there's highs and lows, and it's really hard to be a long-term investor. If you're wanting to be a long-term investor, you have to focus with guardrails on the fundamentals that are going on in a company. You cannot be influenced by the share price. The share price doesn't matter. What matters is what is going on in the company. So if we look at Tesla in specific, there's worries about demand in China, which Adam Jonas at one point, I believe in 2019, said that the most cars Tesla would sell in China would be 71,000 or something like that in a year. This year, Tesla is looking like from that plant, won't be quite China sales, but in a month they did 70,000, I believe, in June or something like that to China. And that plant alone is going to make 750,000 cars. It's this nervousness, this conservatism by Wall Street analysts. They don't want to look bad. They don't want to get themselves on a limb. Now, some analysts have stepped up their game. Credit to Alex Potter at Piper Sandler, Pierre Ferragu at New Street. They have a backbone. They are not being blown by the wind. Like they're not doing that. But what Mr. Market does, and I just have some cheat sheet notes here. That's what I'm doing. This is a kind of I'm adopting this from, or adapting it from, a story that Warren Buffett tells about a farmer and a crazy guy that comes by the farmer's house every day and shouts prices for the farmer's farmland at the farmer. But let's bring it back to something more relatable. Let's say you live in a $500,000 house, and houses are going for that price or more in your neighborhood. Let's say we're in a stable time for housing prices, and someone comes by on your sidewalk, goes up to your door, knocks on your door, and says, "Hey, I'll give you $250,000 for your house." You're going to tell them to get off your property at a minimum. You may not be as nice as that. And then the next day they come by and they say, "Well, I'll give you $240,000. You're not suddenly going to panic and sell them your house for less money because it's gone down from what this boisterous person is saying. And then they come by tomorrow and offer an even lower price. You're not suddenly going to panic. You're going to call the police. But with stocks, we treat that differently. We treat it emotionally. And we're always getting these new prices, and we can check the prices change by the nanosecond. It's kind of ridiculous, to be honest. Mr. Market, this stock market that's telling us new prices every second, it just adds to the emotional roller coaster. And Mr. Market, I think, is something to take advantage of. When stock prices get battered down, that means they're on sale and you're able to find some opportunities. But if you listen to Wall Street, if you listen to Dan Ives today, he's saying he's taken Tesla off his best idea list. So let's say I'm a client of his research, I'm paying his brokerage fees or whatever, and I keep a certain waiting for stocks that are on his best idea list, and I follow that religiously. So then that would mean that I would need to, if I'm following it religiously and he takes a name off the list, then I'm supposed to sell it wherever it is, and then redeploy that money to the rest of the best idea list. So essentially he said, sell Tesla, and yesterday is at 178 or whatever, sell Tesla at 178 and buy something else on my best idea list. it's just ridiculous. And I want to remind people about Dan Ives. So I'm going to share my screen for a second again. And this is April of 2019. So on that Friday, the share price got down to split adjusted about $16. So this was on the Wednesday, and this is shortly after earnings. Dan Ives called Tesla's earnings the worst quarterly report he's seen from any company in the last 20 years. What happened with Tesla in the first quarter of 2019 is it was the first quarter they were shipping cars overseas and great volume, and they sent a bunch of cars to Europe, and there were about 10,000 cars in transit that didn't make it to customer delivery by the end of the quarter. So those cars were going to be delivered in April, but Wall Street's so short-sighted that they just make hyperbole over things. And so he said in April of 2019, when the stock was $16, he can no longer look investors in the eye and recommend the stock. How ridiculous is this? Pierre Ferragu, in response to some of what Dan Ives is saying, is he says the stock reflects two things: fears that Elon loses it and Tesla operations suffer, and fears that Elon sells more Tesla stock. Unless truly worried about one or the other over the near-term momentum, the rational investor would buy the dip, not lower a target price. So this is not financial advice. You need to know why you're owning something. So don't just buy it because Pierre says to buy it. Here's something from James Catt that is looking at the luxury market, I believe, in the US. Tesla up 50%. BMW, Benz, Lexus, Audi, Cadillac, Acura, Volvo, Porsche, all down. And I don't know if that's, I think that's all their sales, not just EVs. So here's something else that I've said. He said, and now we're sitting on top of the peak of the mountain with Tesla in a massive position of strength. Musk has managed to do what the bears have unsuccessfully tried for years. He's just feeding into people's fears. Dan is right here. Crush Tesla stock. This is what he's saying Elon has done by his own doing in what we view as a purely painful, dark situation, cutting price target to 250. Dan does not want to look bad. He's a bandwagon jumper. These Wall Street people are not looking out for you. And this reminds me of sports talk analysts. So let's say you have a middle of the road football team. So the Colts are pretty bad. So let's say a team that's a little more stable than the Colts are right now. And you have a middle of the road quarterback, and suddenly the quarterback has a great game, and then they say, well, this quarterback belongs to be in the top 5 of quarterbacks in the NFL and deserves to get paid that way. And then the next week, the quarterback lays a stinker, and these sports talk people are suddenly calling for the backup quarterback to go in. It's just ridiculous. It's ridiculous bandwagon type thinking. It's short-termism. It's the opposite of what a long-term investor should do. So I just wanted to share this with you today. There's a bevy of charts I want to share. So let me see if I could find that super quick. So just hang with me for a moment. And this is comparing Tesla to FANG. I'm going to share my screen one last time. So this chart was made by Fonz DK on Twitter. This is Tesla's net income growth versus FANG year over year. So it's getting rid of seasonality. Facebook are now called Meta. These companies that go X growth, like Google, otherwise known as Alphabet, they're doing the worst. They changed their name. Here you have Amazon, Apple, Netflix. The financial media keeps adding different companies to the so-called FANG. These are the largest high growth companies that are domestic domiciled. And they've added Microsoft. And I think Microsoft's net income growth caps out at 30%. I think it's probably lower at like mid-20s or something like that. So they've added Microsoft to the FANG. But still, like, it doesn't compare to Tesla. Here, Microsoft's revenue growth, I believe, was about 20%. Here's the sales growth or revenue growth for Tesla versus all of FANG. So Tesla's sales are up 56%. Amazon's the next closest. You can put Amazon, right here, somewhere around 20-25%. Some of these stocks like Amazon have a higher PE than Tesla does. Tesla's been growing like this for years. And Wall Street thinks, oh, well, Tesla, even though they say they're going to grow revenues by 50%, they're not. Next year they'll grow them by 35, and the year after 15, and the year after, or year after 25, and then 15. Here we have operating expenses. Tesla is very disciplined with their expenses. Now, many of the expenses, the highest expenses, are in the factory. So this is somewhat misleading, but Tesla's gross margin at the factory level is superior to many automakers. So what operating expenses include are sales and headquarters, sales, marketing, and administration, and R&D. So Tesla is very disciplined about their R&D, and they get a huge return on investment for that R&D spend. Here's Tesla's operating margins. So at a factory level, this is not gross margins. So this is after operating expenses. But if you look at gross margins, Tesla leads the pack. They may only be exceeded by the likes of Ferrari or ultra luxury car makers who have margins routinely above 30%. Tesla's was a slightly below 30% this year. So again, it's painful and brings about emotions to be constantly looking at the share price of Tesla. And we really shouldn't be dependent on other people agreeing with us if we're long-term investors. If we're a long-term investor, it really doesn't care who agrees with you. But we get excited when Wall Street analysts upgrade price targets and upgrade it from a sell to a buy or a neutral to a buy, that kind of thing. And really, that's not fundamental to the company. What's fundamental to the company is they're profitable today for Tesla. This is in the case of Tesla. They're growing sales, they're growing profits rapidly. much hay is being made about demand in China. Tesla was very bullish on their third quarter call. Some feel it was there some attempt to pump up the stock, but that, if that was their intent, it didn't help. What I think Tesla knows is their intention was to pound Europe with a record number of cars from China. So they're sending a ton of cars from China to Europe, and Europe's gobbling up these cars at a price that's much higher than what Tesla can sell these cars in China. Tesla benefits from selling these cars in Europe. Their gross margins selling them in Europe are much higher. So Tesla's sending out ship after ship after ship. Their exports from China were 55,000 last month, and already in November they sent out 3 packed ships. And this was only through the 5th of November. So we'll see what that if that tempo continues, but Europe's going to get a record number of cars from Tesla, and Tesla makes a lot more money selling those cars in Europe. So that's all I got for you today. Don't pay attention to the Wall Street bandwagon jumpers. CNBC's happy to have them on TV anytime because they will literally say anything. So come on and make the case. Say what we want you to say. If we want you to be a bull, be a bull. If we want you to be a bear, be a bear. Oh, you downgraded the price. Okay, we're going to put you on against a bull who is still positive on Tesla. So to me, it's all ridiculous. It's all noise. And if you don't know why you own a stock, you really shouldn't be investing. And the only reason to own a stock or a company is for their profits. It's for their fundamentals. So anyhow, take care, and it's been good talking with you. Bye.